Here's a simple income idea that's hiding in plain sight. Enterprise Products Partners, ticker EPD. If you like getting paid to wait, this one deserves a look. Let's start with the hook. Income. EPD throws off a steady distribution sitting around the mid 5% range today. Historically closer to the high 6% zone depending on price. It's backed by a 27-year track record of raising payouts. An A credit rating, roughly 1.7x coverage, which means cash flow more than covers the distribution. For income investors, that's the trifecta: yield, history, and cushion. Now the value. The core business is midstream. Pipes, processing, storage, mostly fee-based. About 82% of revenue is predictable and largely insulated from commodity price swings. So instead of betting on oil prices, you're getting paid by volume moving through their system. EPD's been investing heavily, about $4.5 billion in 2024, over $5.1 billion planned after that. Aimed at double-digit returns on invested capital and stable cash flows, recent momentum helps. Wells Fargo upgraded EPD to overweight and bumped the price target to $42. The call ties to a potential structural shift, more demand for U.S. energy exports, growth in Permian gas and NGL supply, Morgan Stanley to $38, Scotiabank to $39, JP Morgan to $39. Overall, moderate buy consensus across the street. Financials, last quarter, EPD posted 0.75 in EPS versus 0.69 expected. Revenue, $13.8 billion versus $12.4 billion expected. Net margin was about 11%. Return on equity, roughly 19%. Those are healthy numbers for a midstream giant. Performance-wise, EPD's outpaced major indices over multiple timeframes. 5-year beta is around 0.57. Today, it's an $85 billion company, trading roughly in the mid-teens on a PE basis, with a forward dividend yield around 5.5%. For a business this stable, that combination of yield, size, and lower beta can anchor a portfolio. And if you care about alignment, the CEO recently bought about $100,000 worth, around $37.55. On cash flow, EPD trades around 8.5x price to operating cash flow, roughly 20% below its 15-year average. If cash flows keep growing with new projects and Permian volumes, there's a case for multiple expansion on top of the distribution. So what could go wrong? First, macro and geopolitical shocks can delay projects or dent volumes. Second, interest rates. Midstream is capital intensive, so higher financing costs can pressure growth returns. The A credit rating helps, but it's still a variable. Here's how I'd frame it. If you're chasing meme level upside, this isn't it. If you want steady cash, defensive cash flows, and a reasonable chance at modest capital appreciation, EPD fits that lane. Durable fee-based business, check. Strong balance sheet and coverage, check. Visible growth capex with solid ROIC, check. Supportive analyst trend and insider buy, check. Valuation below long-term cash flow average, check. That's why I think EPD is a buy for income first investors who also care about total return. Clip the distribution, let the projects ramp, and let time do the heavy lifting. Put EPD on a watch list. Read the latest investor presentation, track coverage, and in-service dates. I'm not here to hype. I'm here to help you build durable cash flow, and Enterprise Products Partners looks built for exactly that. If this helped, tap like, drop your questions, and tell me what dividend name you want next. See you in the next one.